Welcome back to the Keiser Report. I'm Max Keiser. Time now to go to Detlev Schlichter, author of Paper Money Collapse, The Folly of Elastic Money and the Coming Monetary Breakdown. Detlev, welcome to the Keiser Report.
Thanks very much, Max.
All right, Detlev Schlichter, in the book, you talk about the coming monetary breakdown. Are we now in the monetary breakdown?
Well, I think we are getting closer. We're not quite there yet because I do think that most people still have quite a lot of confidence in their paper money and fiat money and in the dollar, even the euro. But I think one of my predictions was that the current imbalances, the current economic problems we have, monetary authorities will try to paper over them by having to print ever more money, by issuing ever more money and providing ever more bank reserves to the banking system. And I think since last we spoke, this is exactly what we're seeing. And we see the ECB has injected more than $1 trillion in there. The Bank of England has just conducted another round of quantitative easing, attempted to do another one. There's constant talk of the Fed doing another round of quantitative easing. So I think we're going in that direction, but we're not there yet.
Okay, so the word around the monetary campfire is possibility of capital controls in Switzerland, possibly in Greece. Talk about what that means. How would that work? Do you see that as a possibility? But what does it mean?
I think it's very likely that at some stage we will see capital controls. I think it's only really a matter of time. And I think this is a strategy by policymakers that is called repression. And I think that's sort of the new word that is being used for it. What that means is, obviously we have too much debt in the system, now in particular public sector debt, government bonds. And already we're at a stage where most of these bonds are being bought by the central banks. Last year, 61% of US treasuries were bought by the US Federal Reserve, so they are practically paid for with the printing press. And one of the strategies is simply to suppress interest rates and keep interest rates below inflation rates, and therefore sort of work off the debt load over time through higher inflation, trying to inflate it away. And for that, I mean, you need to encourage people to hold that debt, to own it, despite the fact that the coupon doesn't even pay for the inflation rate. Normally people won't do that, so policymakers have to force them to hold it. One way is to not allow them to leave the country. Another one is to force banks to hold lots of government bonds, to force your pension funds to hold government bonds via regulation, via legislation. And I think we see a lot of efforts in that direction as well.
Okay, so you're saying that the monetary authorities have been trying to control the flow of money around the world using monetary policies, using interest rates to steer capital as it's flowing through the economy, but these distortions are widening. So now we're going to like a phase two where people in Switzerland are saying we don't want the money to come in at all because we don't want the Swiss franc rising because it's hurting our export market. Right. So they put in hard controls. No money can come in here. Meanwhile, in Greece, they're saying no money can leave, right? So instead of having this fuzzy border that is being massaged through interest rates differentials and it's all very vague, it's a very hard stance. So is it practical in the Eurozone, under the Euro rubric of the Euro, can you actually put in a capital control? Because you have this ECB, you have the IMF, you have all these meta organizations overseeing the Euro. Can you practically put in these kind of capital controls, or is it as easy as flicking a switch?
No, I think it will be sort of technically not that straightforward. I think in particular within the Eurozone. So obviously, if Greece does leave the Eurozone and then sort of exits lots of sort of these commitments, even commitments potentially exiting commitments to free capital markets and free capital flows, all bets are off, and then things could change. I think within the Eurozone as it is set up right now, it will be difficult to introduce that. But remember that behind sort of closed doors, this is practically already happening. If you look at what the ECB gave, as we know, €1 trillion new euros to the banking system, and we know many of these banks turn around, use that money to buy government bonds. And to some degree, they are being encouraged by regulators to do so, or sometimes they do this to increase their tier one capital to sort out their balance sheets. But it's very clear that these banks are being asked to buy their own domestic government bond market. So one of the ideas of monetary union, obviously, to have a free market of capital and allow people to put the money where they like to put it. I think we already see that people are retrenching from this, and there is certainly pressure on Spanish or Italian banks to buy their local markets. By the way, I just heard that the Spanish banks are already accumulating massive losses on all the Spanish government bonds they bought with the ECB money in December and February, because Spanish bonds are still selling off. I heard about 2 billion euros in non-realized losses. So somebody's taking the pain.
Isn't that a Ponzi scheme?
Of course, yeah. This is we're just kicking the can down the road here.
But kicking the can down the road, I can understand you're lengthening the maturities, and that's kicking the can down the road. But a Ponzi scheme is you're creating this relationship between the ECB and the satellite countries where you're actually engaging in a lot of massive fraud at the ECB level to fund fraud on the Spanish regional level in this Bernie Madoff-like Ponzi scheme where you're chasing good money, with bad money with good, to perpetuate the illusion that this is a functioning economy. But I want to move on. I want to ask you another question, which is something you hear a lot now, this past week. Across the wires, it says there's a dollar shortage. There's a U.S. dollar shortage. That there's a scramble for safe assets. There's a scramble for U.S. dollars. However, that would imply that the world is running out of trees, that the world is running out of electrons, right? Because there's no such that's really propaganda, isn't it? There's no such thing as a dollar shortage. That's ridiculous.
Yeah, I think that's I think that's a bit strange. No, there is no dollar shortage. Even with the problems in the eurozone right now and the prospect, at least, of a eurozone breakup or Greece exit. I mean, your euro US dollar is trading at 125.50 right now, and if you look back first 1 or 2 years of the euro, we went down to 88 cents on the euro. We went too much, so the dollar went much stronger, during those periods. So I don't think that we have a very unusual US dollar strength. The other point, I think what we do see right now is the market shifts in an interesting way. If something grabs the headlines, as Greece does right now, people just look for something that perceived to be the safe asset right now. And that is maybe gilts in the UK, here government bonds in the UK, it's German bonds, Bundesanleihen in Germany, and it's even US treasuries and some degree US dollars. But again, it's just shifting the problem to another area. Is that really a safe haven? I think it looks like a safe haven right now, but we all know the US has its own problems, massive budget deficits. As a matter of fact, the budget deficit in the United States is probably not too dissimilar from that of Greece right now, and very, very few convincing proposals to get that under control. As I said before, right now many US Treasury securities are not being placed with savers or the free capital markets. They are being placed with either the own central bank or other friendly central banks. So the whole thing is built on very thin ice.
Isn't that another kind of capital control? In that the U.S. is not allowing for the free distribution of capital as a way to, they challenge China as being a currency manipulator. But the U.S. is a currency. They're all currency manipulators because it's all fiat money, right?
Absolutely right. And one of the reasons why over the last obviously throughout the 20th century, we made a continuous move away from gold and a gold anchor, abandoned the gold standard. And then, as we know, since 1971, even the Bretton Woods system, which was the last sort of link to gold, and one of the reasons was that each government wanted to have their own printing press, their own money, and of course for the purpose of manipulating it. You're absolutely right. The U.S. government is also a currency manipulator. They try to get their currency down, and they are furious with the Chinese because they pegged their currency to the dollar, not allowing it to devalue. But you see, this is why I think we have now among these fiat currencies sort of an implicit race to the bottom. And we see whenever a country, you mentioned Switzerland, whenever a country like Switzerland runs a more conservative monetary policy, as the Swiss have for some time, there is massive pressure for that country, obviously, to see its currency appreciate. Then there are internal political pressures from the export industry and so forth. And we've seen that last year, now that the Swiss government is taking all these measures and the central bank to weaken their currency, or now even introducing capital controls.
All right, you mentioned Bretton Woods came after World War II, an attempt to stabilize global trade, global currency markets. And that was the last time, really, people were seriously talking about a global currency. Remember the Bancor discussed by Keynes. Now people are coming back to that camp as a possible solution. They're talking about a global currency. Some say the IMF with their special drawing rights. This is the ability to expand a global currency. Others want China. they want to step in with maybe something like the Bancor. What are your thoughts on this idea of a global currency? And if one were to take shape, what would it look like in your view?
I'm in two minds here. On the one hand, I am a big fan of a global currency, and as I argue in my book, I think the gold standard was not perfect, but in a way it was the closest we got to a very well-functioning global monetary system. I think whenever you raise that topic, a lot of people push back and immediately say, well, it was responsible for the Great Depression. I mean, we spoke about that last time I was on your show. I think that's wrong. But not going in that direction, just looking at the gold standard was an international monetary system that worked very well from 1879 to 1914. And the interesting thing, it was not under anybody's control, because gold is obviously an anchor that is apolitical, it's not being manipulated by any political entity. Interestingly, a lot of people spoke about sort of Britain being at the time the leader of the gold standard, the leading nation. But if you look at how the gold standard worked, Britain could not really manipulate it and to its own ends. The Bretton Woods system was very different, because now after the Second World War, America was under control. So if we go back to one global currency, I would argue strongly it would have to be something that is not under the control of any of these governments, and it would have to be completely apolitical. And again, I would see a gold standard would actually work. I do think we could go back to some kind of gold standard, but I think my concern is that the politicians don't want to give this up now, this ability to manipulate their currencies, to set interest rates, to stimulate the economies artificially, in my view, by printing lots of money, injecting bank reserves whenever they want into the banking system.
Well, let me put on my Barack Obama hat for a second and say that it's not about going back to the gold standard, it's about going to the future of the gold standard. You see? Therefore, it's palpable. Go to the future, hope, change, gold standard. Oh, voila! Yeah. You've got it. You figured it out. Okay, buddy. Now you've got the policy. Now do it. Now, what about Britain? Right here in Britain, the IMF is calling on the Bank of England to cut rates, introduce more quantitative easing. And in Britain, what's the effect? Not good.
That from my point of view, and this is why I'm so suspicious of having a global paper currency, because my fear is it will be under the control of the IMF. And as you just said, I mean, the recommendation from the policy elite in the IMF is always to print more money, do another round of quantitative easing, stimulate your economy again. I mean, we've done this for many years now, and in my view, we are in this mess because for 20, 30 years, whenever the economy rolled over, we lowered interest rates and printed more money. The reason why banks are overstretched, why governments are highly indebted all around the world, is because we always stimulate our economy by providing it again with cheap money.
And what do we always come back to?
Gold, the gold standard.
Detlev Schlichter, we're out of time. Thanks so much for being on the Keiser Report.
Thanks so much. Thank you, Max.
And that's going to do it for this edition of the Keiser Report with me, Max Keiser, and Stacey Herbert. I want to thank my guest, Detlev Schlichter. If you want to send me an email, please do so at keiserreport@rttv.ru. Until next time, Max Keiser saying bye, y'all.